Well, good afternoon, everyone, and thank you for joining us today from wherever you are, most likely at home. Today's presentation is presented by Ardmore Banking Advisors, and it is Pandemic Portfolio Stress Testing Trends and Techniques. Sure to be a topic on everyone's mind right now. Before we begin the presentation, I'm just going to give a couple of housekeeping items here. Just in advance, we are planning on distributing the slides for this session to all attendees after the presentation has concluded. So you'll be getting those pretty much right after the session ends. The console on the far right side of your screen will help you to control the GoToWebinar features, including any questions that you might have come up during our presentation. If you want to minimize the console, just click the horizontal line that is just to the left of the X in the upper right-hand corner, but don't click the X because that will kick you out of the session. We wouldn't want that. If during the course of the session you have a question, please feel free to type it into the box as shown here. We are planning on leaving time at the end to answer your questions. If we do not get to a question that you've asked, we will follow up with you in the near future to go over anything that we're not able to get to. Now, it is my pleasure to present to you the speakers for today's webinar, and we're going to start with Peter Czerpak. Peter is Ardmore's Senior Director of Credit Technology and an Ardmore partner, and has been helping community banks with stress testing since 2007. Peter has been giving presentations on stress testing and CECL for conferences and regulators, and has been published on articles on CECL stress testing and a thought leader in various publications, including American Banker and the Risk Management Association Journal, among others. Next up, we have Todd Sardich. Todd is Ardmore's Senior Vice President of Credit Risk Management Consulting, and he currently manages Ardmore's stress testing line of business. All right, and before we get them started, we're just going to do a brief overview of how we plan to approach this presentation. So we'll take a look at the planned agenda. So after a brief introduction to Ardmore and some of the services that we provide, we'll move on to an overview of stress testing and its particular importance in the current climate. After that, we're going to move on to trends that have developed in the early efforts to stress test the pandemic and present you with some sample stress testing results. We will conclude by demonstrating the proprietary services that helped develop those sample results and finish with a question and answer session. So at this time, I would like to turn the presentation over to Peter Czerpak. Peter?
Thanks, Matt. And I'd like to thank everyone for attending this important webinar. We know that your time is valuable, particularly now. And certainly COVID webinars are spreading like, well, they're spreading all over the place as well. So we appreciate you choosing our webinar. The situation is fluid and we want to keep you up to date. I just want to say before we get started that the objective of this webinar is really that Ardmore Banking Advisors recognizes the gravity of the current situation, the COVID-induced recession, and its impact on your borrowers and on the banks themselves. So we want to try to help, and we want to help the industry by sharing our expertise on stress testing that we've learned and used for many, many years, and actually offer to perform a abbreviated service to support your institution, which we'll get into some more details about later. For right now, for those of you who aren't that familiar with us, we've been around for a little more than 29 years, and we're a full-service credit risk consulting firm, helping particularly community banks. And we've done so with three lines of business, which include loan review, credit risk consulting, and credit technology. As you can see on the slide, we do a number of things for a lot of institutions and have for almost 30 years. Loan review is our lead service, but we also perform stress testing on an outsourced basis and sell technology to do it as well. We also do credit data assessments if your institution is not sure if you have your data in order for stress testing or CECL. We can help you with that as well. Our credit technology, which we've had since really 2003, include My Credit Insight, which is a credit portfolio management tool that slices and dices portfolio, generates reports on demand. Our stress testing tool, our automated loan review platform, LR. And we also do consulting services, including outsourced stress testing services for institutions who subscribe. And we also support partner-developed software such as the Argus CECL Ready platform. All right, so that's it with the propaganda. Let's get into the stress testing overview. I want to just take a couple of minutes before Todd comes on just to put some context behind stress testing and why it's important and where it came from. So key elements of any stress testing program, and stress testing means a lot of things to a lot of different people, but that it's predictive and forward-looking, and it helps the institutions understand potential risk and vulnerability in their portfolios. That's, primary. In addition, we use data to help support subjective conclusions about areas of extra risk or vulnerabilities in your portfolio. So it is data-driven, but it is a directional data drive. So I know some institutions get concerned that they don't have enough data, or the data may not be 100% correct. This is not a scientific exercise. It's a model. And as people say, all models are bad, but some are useful. We think this is a useful model. It helps you make better decisions about risk within your portfolio, and it's really intended to be an actionable result from stress testing. If it's not being done properly. This shouldn't be something that you get and read and put down. It should be something you get and look at and say, now I'm going to take some action based on this information, or at least be ready to do so. It also is linked to capital planning, and as we'll show you a little bit later, capital planning is part of the entire process of stress testing. We also have to tailor the complexity of the stress testing for the bank's risk appetite and the complexity of its lending exposure. Now, that's not as important today in the COVID environment as it would be in the regular stress testing program, but still something you consider. Basically, the regulators look at stress testing as helping to answer these three essential questions. Do you have sufficient capital, considering the risk profile that you're following? What segments or concentrations in the portfolio are most vulnerable to stress at any given time? And should the bank's risk management strategy be adjusted based on these results? Stress testing has been around for a long time. I've been doing presentations on stress testing since 2008. But back in 2004, it was originally part of the Basel II Accords, which was pretty much ignored here in the US because it wasn't adopted, but that was floated out then. And in 2006, the interagency guidance on CRE risk management came out at the end of 2006 with a famous 100% growth, 300% of capital rule. And this really started out stress testing for banks of all sizes. In 2009, during the last Great Recession, the SCAP test was held. That was a capital stress test intended to make, add comfort that large banks could withstand problems in their capital adequately, and most banks did pass, and it was looked to as an example of the health of the banking system even in times of great stress. In 2011, they proposed the idea of the Dodd-Frank Act, which we all know, which included stress testing, a mandatory stress testing program for all banks over 10 billion, and the CCAR capital stress testing guidance for banks over 50 billion. In 2012, we did get guidance on community bank stress testing from the OCC and an article from the FDIC. And in 2014, Dodd-Frank was put into action for all banks over 10 billion. And in 2017, it was changed and taken away so that banks under 250 billion did not have to do Dodd-Frank stress testing anymore. So that's just a quick look at the last 16 years of stress testing, to give you some context. So let me wrap up with talking about the models that we're going to see today and how they get used. We're looking at a portfolio stress testing model for the pandemic stress test. The portfolio stress testing model, also sometimes called sensitivity shocking for the portfolio, is what many community banks use right now to test the vulnerabilities in their portfolio on a regular basis. I believe one of the COVID webinars I went to, they polled the audience and 80% of the audience said they were doing some sort of portfolio stress testing on an annual basis at least, and some were doing it more frequently. So the concepts that were laid out in 2006 CRE guidance and then reinforced in the 2012 OCC guidance on stress testing community banks lays out exactly how to do this, and that's what we follow. And in this case, we're looking at local market, when possible, concentrations, and we're looking at vulnerabilities in particular segments. And investment real estate is always considered the most volatile and potentially biggest impact on banks' risk profile. These shocks then are created in scenarios that are supposed to simulate likely potential problematic economic conditions. Todd's going to give you a little more detail on that later on in the presentation and how the COVID-induced recession could be simulated. And again, the idea is this model is really useful for smaller institutions that don't have a lot of data, don't have a lot of modeling resources, they don't have a quant department. It can also be used for larger institutions, but maybe in more depth or with more detail and more slicing and dicing because they have more data and more resources to do it. We will look at both top-down stress testing and bottom-up stress testing. That's to distinguish it from loan-by-loan stress testing that your institution might do at originations. This is actually looking at the entire portfolio at a point in time. The top-down view is going to be looking at portfolio segment impact on the entire segment. Bottom-up would be to target individual credits that may be underwater based on stress conditions. So that's the kind of actionable information it should generate for you. And the bottom line goal is to try to tie the results of this stress test to your capital planning and focus on potential at-risk loans that you may have to deal with. The different models and drivers are slightly different. Probably the most frequently used model is stressing the appraised value of properties in the CRE world. You really need the appraisal amount, date, and in addition to this, you obviously need the outstanding amounts and account numbers and things, but these are the main drivers. The realized value discount is really applied when it looks like a credit could be underwater, applying a additional discount for collection and recovery processing. That's something that was recommended by the FDIC. You don't just take the actual value discounted by the shock, but you add a 10 or 15% haircut on top of that. Debt service coverage model is more focused on using cash flow, and as is the NOI cash flow or income valuation model. This is a model, these two models, the last two are probably what make more sense during the COVID stressing because appraisal amounts are very hard to get at this point. They're not necessarily representative of the actual value. And recently we've even seen some direction from the regulators on not focusing on appraisal values. The interest rate model obviously adds interest rate into the mix. There is such a thing as C&I stress testing as well, but it's really based on stressing the operating company financials. It requires a lot of data, number of different fields, which we can outline later on. But we're going to focus mostly on the impact on properties, and that's what Todd's going to talk about. There are other models as well. We've done stress testing on construction portfolios, for example, which is a very complicated process, and other specialty types of credits. So with that, what I'd like to do is now turn this over to Todd. Todd does a lot of the outsourced stress testing work for our clients and has been working on how to apply these models to COVID. So Todd, I'm going to ask you to take yourself off of mute and take it from here.
Thank you, Peter, and good afternoon, everybody. Thanks for joining us today. I wanted to really start out by saying that generally the comments that I'm going to make in the preceding slides and some of the risks that might be associated with particular CRE property types are created or were made to identify and illustrate the potential impacts that the COVID-19 pandemic is going to have. But as we know, this situation is changing continually, and what we say today might be out of date tomorrow. We consider stress testing to be forward-looking, as Peter mentioned, for any part of a sound credit risk management program, but the statements that we're going to make in the slides following shouldn't be interpreted as any type of economic forecasting by ABA, but rather, or Ardmore, but rather what if scenarios and what they would do to potential impacts of the segments. So when we talk about CRE segments as a whole, the different thing with really this pandemic is every segment is going to be affected in some way. There are certainly going to be some that are more impacted than others, but it's, you know, as a whole, everything's going to be impacted. And when we see these segments moving, you know, together at the same time, they create a type of a contagion by illustrating different risks and different properties are then translated to different segments within the economy. So some of the segments I'm going to focus on in the next slides are ones that we feel are more vulnerable based on, you know, the potential impacts of the pandemic. Generally, when we're looking at creating scenarios and we're looking at CRE segments, we want to take into account regional and local and as well as national market dynamics. The challenge is with this is we don't know what the depth of this is going to be and how long it's going to last. So tying scenarios to actual forecasted economic indicators or even looking back at the previous recessions is difficult. We're going to primarily focus on CRE, but as Peter mentioned, C&I stress testing of individual borrowers and industries in this market or in this pandemic is going to be very critical because of the number of operating companies in the global supply chain that's going to be impacted. So on this slide, when we're looking at creating pandemic scenarios, really the drivers of this are going to be the length of time that the shutdowns are going to be lasting, and then the degree of the economic disruption and the recovery effort. So when you're building and considering scenarios to do this, those are really the drivers that we want to take into account. In this case, I just developed a baseline, a moderate and a severe scenario building that basically looks at slight economic disruption and brief economic shutdowns, all the way to a severe scenario that might reach some, you know, into the summer, hopefully not, reaching into the summer, and then a severe economic disruption of the CRE market as a whole. So a lot of the scenario building that you're going to want to look at is really going to be based on, you know, how is your market, the geographic market that you're operating in, how is that impacted by COVID-19? Obviously, in New York City and other places, we have epicenters where it's affecting, you know, the area much more than, say, in St. Louis or in other areas of the country. So you want to keep that in mind when we're doing this.
Hey, Todd. Todd, I noticed. Yeah. I know there's a lot of webinars going on right now with particularly Moody's and some others that are showing a lot of scenarios with lines and projections. Is that the same thing as this, or is this more of a general directional view?
Well, this would be more of a directional view of it, and really estimating your adjustments, which we can talk about a little bit later in the slides, and what the adjustments for a baseline, a moderate, and a severe might be.
Great, thanks.
So when we're talking about basic portfolio modeling concepts, we want to measure collateral changes, which would be the LTV component or the loss given default component, and then the changes in cash flow, which would be affected by, you know, increases in vacancies, and this would measure your probability of default. So when we make changes, we want to drive down, you know, NOI and cash flow, assuming cash flow is impacted by the borrower, you know, by the property, and then, you know, by the borrower's realization of that, and then driving the cap rate up to imply a decrease in value. And that goes a little more to, I like this model a little bit better because we don't really know the impact of, you know, appraisal values and the ones that we're historically storing in our databases and banks. There's really nothing right now to normalize them to see what the current level is. So until we can see the degree of this, I like the directly capitalize these properties, because you could make your scenarios built around assumed decreases in cash flow and driving cap rates up to see what the impact of the LTVs would be. Now, I mean, cap rates in general, obviously they're going to give us a look into the property value, and they're highly correlated to capital markets, as we know. And sometimes there's a lag in there depending on activity, but it's going to give us a general proxy to where we want to get to. It's not an absolute measure by any means, but at a particular point in time, but it's going to give us the directional trends that we're looking at. I mean, right now, in most property segments, at least through the end of the year, cap rates were at some of their lowest levels that they had been in 20 years, particularly multifamily. So we can expect change coming in there. The first segment that I want to talk about is the hotel and hospitality trends. And a lot of these things are knowns to everybody on the call, but I'm pointing them out for items to consider when you're building scenarios and considering strategies to stress test the portfolio. So as we know, hotels and motels across the nation are currently operating on a minimal basis, or they're closed altogether. This is an indefinite period of time as of now. It's to be seen as we start to open those up. And as a result, a lot of major conferences and high-profile events around the country have been canceled and postponed. In larger markets that are destinations for conferences, they're severely impacted because those are a good share of their annual revenue. Most business travel has been suspended, and leisure travel will be disrupted for an unknown period of time. And I think this is going to last beyond the opening of the hotels, because people are going to have to weigh the confidence of going out and traveling with the impacts of their individual employment situation, where we have record numbers of unemployment, and consumer spending is going to be affected by that. A lot of companies are going to want to maybe consider adopting technology and doing more virtual and video conferencing technology like Zoom, GoToMeeting, things like that, to cut down on face-to-face meetings. That's going to impact occupancy. There's going to be a pent-up demand, which I mentioned. People have been locked at home for several weeks now. There's going to be a demand to leave the home, but it's going to be a balance depending on when that recovery is going to happen, because people are going to have to weigh, their safety and their consumer spending and anxiety, things like that. I did want to point out that room supply since the last recession has increased about 500,000 rooms since 2009, which is roughly about 10%. And those really came in the select service hotel brands as well as extended stay. So the downside as we come out of this, as we come out of this pandemic, might be could potentially be greater than we saw in 2009, just based on the overall room supply that's out there. CBRE is forecasting a 29% decline in occupancy for 2020, but this is, forecasts are really fluid at this point, so there's that's really hard to pin down. On the next
Todd,
slide,
you mentioned here, Todd, the adopting alternative technologies. Is that related to, for example, maybe industry groups are not going to do conferences in person anymore?
Well, I think that's a possibility. I think that's national institutions might be opting to do more web-based conferences than in person, particularly with the RMA, for example. Many of the people on the call are familiar with that. A lot of those conferences and seminars and continual learning could be transitioned into virtual, and also some in-person meetings, with customer contact could also, follow suit as well, reducing the need for travel and things like that. So I think that's to be seen, but it's a definite possibility. When we talk about the next two charts here show, this is from Smith Travel Research, and this shows RevPAR trends for the last two recessions. That would be post 9/11, which was more regionalized, and the Great Recession of 2009. And as you can see here, this breaks out hotel locations based on the area more than the actual geographic location. But all of them saw large RevPAR declines in some of them approaching 20%, much greater in 2009 than 2002. But this was coming out of the recession in the 12 months thereafter. The bottom chart just bifurcates the data a little bit differently. This shows it based on the hotel type. largely affected luxury hotels and select service and full service hotels, but all of them were negatively impacted. When we talk about the individual property types, we're also considering the impact on the supply chain as a whole. We talk about hotels and the impacts of hotels, but there's a lot of ancillary businesses that are dependent on the hotels that are impacted. We have grounds maintenance shown here, laundry services, food services, etc. All of these are going to be impacted by some way of the pandemic, and should be considered on, when we talk about the C&I basis, a lot of these are going to be operating companies looking at stress testing those companies impacted as well. I'm going to move on to multifamily next. Historically, multifamily properties, for the most part, has been somewhat defensive towards recession and has fared a little bit better than the rest of the property types. Generally, they're benefiting from more stable income streams, and there's more of a demand. There's always going to be a demand for the apartment renter, so they do have more defensive characteristics than most property types, but they still are susceptible to shocks. And going down through the bullets here, the general apartment renters, a lot of them are living paycheck to paycheck and are more susceptible to periods of economic disruption. When we look at unemployment, it's at its highest level right now that it's been in 40 years across the nation with mass layoffs. We could see in the chart here that I'm tracking unemployment and vacancy rates in hotels, and they're highly correlated. So that's obviously something to consider. We also have leases with apartments are generally 1 year or less, and a lot of smaller properties are probably more susceptible when you have less complex investors and generally less liquidity. Lower levels of inventory are likely to come online in 2020, but that is to be seen. And there is a current moratorium on in a lot of areas on evictions for the areas that have been most severely hit. But those will be lifted at some point in time, and depending on where we are with recovery and unemployment situations and stimulus and things like that, it's something to consider as evictions rise and vacancies rise and things like that.
Todd, question, if I could add. There was a lot of concern that multifamily was a bubble that was going to burst, and I know multifamily you do stress testing on that segment almost always, regardless of institution. Do you see possibly that this was sort of an inevitable burst, and that the COVID-induced recession was kind of inevitable by some trigger, or do you think this is just an anomalous thing?
I don't think it's as much of a bubble as much as a correction, if that makes sense. We're not going to see declines in the multifamily segment like we saw the housing market collapse in 2009. At least I wouldn't think so, based on the fundamentals of the property. But what we will see is a correction to abnormally low cap rates, and which are abnormally high prices than what we've seen. I mean, in some markets, multifamily pricing on sales has been 10 to 20% above previous peaks of the segment ever. So I think that there will be some sort of a correction that happens, but I definitely think that it won't be as susceptible as the other segments are to the recession.
Okay, thanks.
Sure. Student housing is another one that we have up here. With the mandated closures of colleges and higher education facilities, student housing is going to be impacted. A lot of times, properties are leased going into the spring for the next school year, and substantially leased. So I think there's a lot of uncertainty out there right now. Leasing might encounter a wait-and-see approach by parents to see what is going to happen. What is going to happen going into the 2021 school year. The impact of distance learning is something to consider. We don't know where that's going to go yet, but a lot of colleges and even down to elementary schools have had to adopt some type of distance learning programs with the closures right now. And colleges and I guess other schools alike might consider continue some of these programs and offering more distance learning capabilities with less physical classrooms. So, it's something to consider. I don't know exactly how that would, how that'll all shake out, but it's definitely something that we've talked about internally to consider. And uncertain demand is going to impact the construction and progress of current projects, either those that are under construction or those that are in the planning phase. There are certain ones that are well on their way, projects right now across the country. So, those have the potential to be impacted through this based on, where leasing goes. The next segment I'm going to talk about is office. Really, we're in the midst of right now the largest, work at home, work remotely test that the country's ever seen. So companies have had to equip employees coast to coast with stay at home work capabilities. As we've gone through this, and the companies have actually, businesses have gone through this exercise, there might be a realization that they might want to occupy less office space going forward, should this, pilot program, if you will, come to be effective. So physical office space occupation or occupancy might become, a little less robust in the coming out of this recession. Smaller offices with smaller office properties with more short-term leases are going to be more affected because as leases begin to, they're expired and we're in the renewal stage with a borrower, the landlord's going to have less negotiating power, maybe on lease rates or effective rents, because they want to preserve occupancy. Looking at the chart here, this was a chart I pulled from the Raleigh-Durham market, and we saw cap rates, for example, on office properties really reach their highest point in 2010 and 11, and they're currently, through the end of 2019, performing pretty well. They're pretty much at their lowest point. But I think we can all agree that this is going to change as we come out of this, depending on the remote work aspect of this.
And again, Todd, this looks like a segment, if I can just add, it looks like a segment that was possibly on the downturn anyway, and this COVID-induced recession just is a massive accelerator on the decline.
Right. When we talk about retail, that's a segment that I'm really encompassing retail as well as restaurants and other, small store discussion. The global retailers are facing a lot of risk right now because of the mandated store closures, as well as restaurants across the country are all closed and only offering takeout only. I think we can all agree that generally restaurants cannot survive in the long term based on takeout only, and there's going to be a fair number of restaurants coming out of the recession that, quite frankly, aren't going to be able to recover from this. The chart on the left that we see here, this is pulled from Open Table, and we're seeing these obviously grind to a screeching halt in March with the closures. The degree of recovery is going to depend in large account with items we talked about prior, unemployment and consumer spending and confidence, actual confidence to go out, and security, the feeling of security to go back out into the restaurants, and how long that's going to take. As far as restaurants go, there are a lot more restaurants than there were at the last recession by a considerable amount. People are spending a lot more money, or people have been spending a lot more money in restaurants. This is obviously due to change. And as a whole, the restaurant economy, or the restaurant industry, has become a much larger piece of the economy. About 2 million workers have been added to that piece of the industry, the restaurant industry, over the last decade, which is about 8% in that segment. So A lot of those people are obviously currently out of work, and it will be seen how many more are going to be put back into the workforce. The fast casual sector has been growing in the restaurant industry, but conversely, it's putting a lot of the casual dining establishments out of business by even before this recession, based on the fast casual sector. The biggest impact that we're looking at on retail is the Amazon effect, and obviously that's real. People are buying non-traditional items now through this pandemic online using Amazon or using other platforms, and I think we could probably estimate or assume that a lot of that is going to continue as we go forward, taking not going into the typical brick and mortar retail, but doing more of it online through Amazon or other things. Another thing to consider on that same note is a lot of the big box retailers have robust platforms out there to fulfill orders and online ordering platforms, but the small retailers that we see in community strip centers like that, a lot of them are left without infrastructure to sell and fulfill orders online. So to the extent that online sales continue to increase, those smaller retailers and mom and pop type stores that don't have those capabilities are going to get less foot traffic and could become affected. So what does all this mean? When we talk, Peter mentioned earlier, we want stress testing to give us actionable insights. So I have these broken out into a couple different sections. We want to, you want to be able to use stress testing results to create a proactive action plan where we can look at adverse effects of particular segments and lead to possible changes in internal concentration management, or maybe we want to look at underwriting advance rates for particularly undesirable characteristics in a property type. Another thing that stress testing is going to give you is the ability to identify missing or stale data. And data is the cornerstone of a stress testing program, because without it, without current and complete data, for the most part, you're not going to be able to do your analysis. Another important aspect of a good stress testing program is going to include trending over time, as well as back testing. So when I say back testing, I'm really referring to seeing if your scenario creation up front when you were doing this was too harsh or may not have been harsh enough. So, again, these are a couple actionable insights we can take out of stress testing. There's obviously more to that are particular to your bank. So, on the coming slides, I did put a couple of scenarios and stress testing results together, so we could just take a look at what some of these might be. And these are general and generic; they're not tied to any particular market. You might see different cap rates or different NOI adjustments in your particular markets. But this one, the top section of this really looks at the hotel, and it created three scenarios: a baseline, a moderate, and a severe. And you'll see that we started with a cap rate of 7.5%, and that's average. So that's the weighted average of that entire segment of loans that you're looking at, was 7.5%. In the baseline, we drove it up to 7.9, and in the severe, we drove it all the way up to 9.75, and that's going to measure our value with our declines in NOI. Because hotels are closed right now, I started with a baseline of 20% and went all the way up to 50% from an NOI decline. So you can see at the bottom what that really does to your data. I mean, in this case, we started with a weighted average LTV of 60%, and it drove that all the way up to 104% under a severe scenario. Conversely, it reduced our cash flow or our debt service coverage from 1.67 under a baseline or under original to under 120 or 1.2 times under a severe scenario. You see out to the far right. Each time we're doing this, we want to calculate, really, we're looking at the probability of default component, which is your cash flow, and we have an LTV, but we want to look at what's the potential capital impact. So we have that listed as a potential collateral shortfall. And what that really is illustrating is when we're doing stress testing, when a loan, an individual loan drops below a debt service coverage of 1.10 and an LTV goes greater than 90%, it calculates a potential impact or a potential collateral shortfall. Now, I think we can all agree that that is not an absolute number, because really that's assuming all of your loans default. You have to apply some sort of a probability of default when you're doing capital analysis into those potential shortfalls to come to an actual realizable loss. But it gives you an idea of how many of your loans that you get, on a pool basis, under different scenarios, how many of them are going to be underwater per se. So when you look at the next slide, this is actually from our application that we're using. This just breaks down a single scenario a little bit differently, and I know there's a lot on this slide, but this is really just showing a pre-stress and a post-stress picture from our from this one scenario. This is a multifamily scenario, and it's showing the same things that we just talked about, the changes in LTV and changes in debt service coverage ratio. At the bottom is an important metric when we look at benchmarks that we want to set. So generally, we want to say an 80% LTV and a debt service coverage of 120. That's something that we would say that's an average, not necessarily an average, but a safe measure. This is showing us how many, under stress testing, how many of our loans went either above the LTV or below the debt service coverage threshold. And when you're doing analysis, those could be the loans that you're focusing on. Those are the loans that you might want to do some more internal analysis on to see, are there particular risks or actionable insights that you can get, from those types. So measuring those breach limits is kind of a secondary analysis that you would bring forward through the stress testing exercise. This is considered a top-down approach. You can see in the middle that Peter's highlighting the estimated collateral shortfall under the scenario was about $9 million. But again, you have to add some sort of a probability component in that to really tie it to capital and make it meaningful. On the next slide is a bottom-up approach. This is where we're looking at more individual loans. You do a lot of this at the onset on underwriting when you're doing sensitivity analysis. This is really doing it on the back end when we're applying adjustments to individual loans and then adding them all up into a combined amount. And as you can see here, we're making the adjustments to, I think, 5 loans here and what those impacts would be. Both results are meaningful. Both results are, similar purposes, but could be used a little bit differently when we're looking at that. And the last item I want to show on here before I turn it back over to Peter is a chart that we like to use. It's really a management type analysis or a board level analysis where we can look in a matrix over time over scenarios what stress testing is doing based on a percentage of the portfolio. So really what these percentages are showing is as loans move on, originally we had 34% of our portfolio was 60% or less. Under a severe scenario, it's 8.97, and a lot of those loans went up the ladder of LTV tranches. And it's the same way with debt service. But this gives you a really clear picture of what how your portfolio could shift over time. And you can really do this with different data as well. You could do this with shortfalls. You could do this with breach levels. But this is, it's a clear picture of what stress testing outputs are, and it all goes back to the data. So with that, I've talked enough for a little bit. I'm going to turn this back over to Peter, and thank you for your attention.
Todd, before you go or pop off for a moment, I know we try when we do stress testing to tie the scenarios to some economic, look back levels, some sort of guidance from historical recessions and the like. Are we proposing that the shocks that we're going to give on this portfolio are similar to the worst things that happened during the last recession, or do you think it's going to be worse? What's our approach there?
I think that, typically, and thanks for pointing that out, typically when we look at drivers, we look at rent growth, we look at vacancies, we look at cap rates, as you know. A lot of those are unknowns right now. There are projections out there. We use a couple of paid services that do offer projections. But for right now, when I'm doing particular outsourced portfolio analysis right now, I'm doing the trough of the last recession as the severe for the most part, increasing hotels a little bit, in retail a little bit more than that, and the critical in this case, this critical or the moderate is somewhere in the middle. The challenge is we can't really normalize anything right now because we don't really know where it's going to go. So the application of the scenarios is a little more generic, and I don't really want to use that term generic, but it's really more of a 5, 10, 20 approach, something like that, because we don't really have empirical forecasting or data to tie it to. And that's why we're not really using appraisals right now, because there's nothing to really normalize them to. So, the last recession, I think, was a good proxy. You might want to hit a couple of the segments a little bit harder, like retail and hotel, like I said, just based on the impacts of the pandemic.
Okay, thanks, Todd.
Mm-hmm.
Now, what I wanted to do is, as I mentioned at the start, and we were concerned about what we can do to help our fellow institutions, our clients, and others. So we're offering a service that is not our full stress testing service. It is not as involved. It's intended to be a fast, relatively inexpensive, low-cost service just to help you pinpoint potential vulnerabilities in the portfolio, both in segments and individual credits. So I want to describe what that is, and if anyone's interested in that, they can reach out to us and we can talk about how we can do that for you. We believe that we have the data from you, we can do it within a week. So what we're saying is, in this simplified outsourced stress testing for a pandemic, we would stress 3 CRE segments. We would use only the income-based valuation because the collateral really isn't stable enough. When you select segments for stress testing, we would suggest you look at the ones that Todd went through today. And also, if you are a very small institution and you have less than 10 or 12 loans in a segment, it's probably not a lot of value in doing stress testing for them. We're really also not going to be stressing already impaired loans because, we already know about those. We're really looking at the rest of the portfolio. And we're trying to shoot for 60% of the total. And that's going to help you from a coding perspective as well. For the codes that we need, which we'll talk about in a second, you don't need to code every single credit. But if you can get 60% of the portfolio, maybe in your top 25 borrowers, that would probably be sufficient for the test. We would do a moderate and a severe. And we're not able to do regional customization because we're offering this to clients and prospects in any region. So we'll be using sort of regional and national, we'll be using national trending. From a data standpoint, as Todd's pointed out, we can't do it without data. So what we'll do is we will send people who are interested in doing this, we'll send you an Excel template, which you can fill out. And we'll also include a description of what the fields are. But basically, to do this quick stress test, directionally correct for the pandemic, we only really need 6 fields. A loan number, a balance, some sort of property type indicator. And this varies by institution. It might be for your institution, you might use collateral codes. You might be using CRE property types like office, retail, multifamily. Might be using call codes. Obviously, the more specific you can indicate what property type is represented, the easier it is for us to slice and dice the portfolio into those categories for the different scenarios. The property cash flow or net operating income is what we need, and as well as the annual debt service amount and cap rate. So we can supply one as an average, or you can supply cap rates as well. The deliverable will be a report. That'll probably be a couple pages of analysis of what we see when we run these models on your portfolio, and some example reports from our my CI stress testing program, which you just saw. I just walked you through. And we'll have a chart similar to the one that you saw at the end there per segment. So if you're interested in that, please just drop us an email or a note. You'll get a follow-up email from us if you attended the webinar, so you'll be able to reach back to us if you're interested. We have a few minutes left, and I know Todd's been really fire hosing us all with a lot of really good information. It can be somewhat hard to absorb, but if you do have any questions, if you want to write them in the question box down there at the bottom of the screen, just type them in. We'll be the only ones who will see them. Feel free to do that, and we can then respond to any questions. So have a couple of them. If you have a thought or a question, please include them. This first one is actually about the data requirements. Todd, we have on there that the cap rate is an optional thing to provide. Can you explain why it's optional and how you would use it?
Well, it's, generally a lot of this information, such as cap rates, aren't going to be in the core system in a lot of smaller community banks. And it's going to take resources and time to pull those out. So if you don't have that information, what we could do is we can use proxy cap rates for a market. We have access to national databases. So what I would do is I would basically pull an average cap rate for that property type through the end of the year, and in your geographic market per se, and then we would use that information. It's actually not a bad measure because, in theory, the behavior of your portfolio within a certain market would likely behave the same way. So we have access to that. If you have it, great. It's better to always use your own data, but we could use proxy data for the cap rate if you do not have it.
Okay, thanks. The next question I have has to do with the frequency of stress testing. I mentioned in the beginning that annual stress testing for a smaller institution, say a community bank, was typically sufficient. Do you think that due to the ever-changing situation with the pandemic that it would make sense to stress test more frequently under the current conditions? What do you think, Todd?
I think as far as frequency goes, yeah, I mean, I think these are obviously times we haven't seen before. I think more than the frequency of stress testing, you pay more attention to the validity of your stress testing assumptions. So if you did a stress testing today and you come out 2 or 3 months from now and items have drastically changed, or the economic indicators have changed, you'd want to go back to validate that I make my stress scenarios, sufficient enough. If not, I would, do the stress test again under those new scenarios. But if they're directional to what you had already done and things haven't changed that drastically and your scenarios seem to be appropriate, there wouldn't really be much value there because it wouldn't move the needle much.
Okay, thanks. One more here about, they ask, why are we not talking more about CNI stress testing? Is that not more volatile during this pandemic? Or what are your thoughts, Todd, about CNI? I mean, I can say from my perspective, I always have concern about how accurate it is to group, let's say, underlying businesses together and saying they all react to stress in a similar manner. But under a pandemic situation, that may not be as much of a concern. What do you think about the CNI stress test, Todd?
Well, first on the CNI stress test, the challenge is you need a lot of data. you essentially have to look at a mini spread, if you will, of the business and apply the stressors to those particular items, whether it's going to be EBITDA, whether it's going to be revenue or other expenses, things like that. A lot of times spread systems aren't integrated into bank systems, so to being able to pull that data out is more timely. Whoever asked the question, you're 100% correct. It's very, very important right now. And we actually are in the process of doing some for some of our clients at the moment. But when Peter mentions industry, you might have two borrowers within the same industry, but are going to behave a lot differently. Because you might have a middle market company manufacturer, and you might have a smaller end user, and they might be in the same industry, but they're not obviously doing the same function on the supply chain. So the challenges with C&I stress testing are segmenting the portfolio the right way and getting the right pools of loans to segment, and then being able to then pull out the necessary and relative financial information to stress it on. It's obviously it's the same metrics, it's the same process that you're going through to build scenarios and to do the analysis. It's really data heavy though right now, for C&I. So if you have the data, we're happy to talk to you about that, offline or whatever the case might be.
Thanks. Well, it looks like we're about out of time, Matt. I don't know if you want to wrap us up. And we'd like to, I know, speaking for Todd and myself, thank everyone for your time today. Hopefully this was useful. Matt, we're going to send them the slides, right?
That's correct. Everyone who attended will receive a copy of the slides. If you have any additional questions, please email Peter or Todd, and feel free to visit us on our website at ardmoreadvisors.com. Thank you all for attending.
Thanks, everyone. Good luck. Stay safe.